Good morning from our global headquarters in New York. I'm Menace Craney. You're welcome to Bloomberg Brief. Let's set your agenda. Rhetoric and softer inflation legitimize the pathway to rate cuts. Atlanta Fed President Raphael Bostic opens the door for September, warning we can't afford to be late. Diverging Asian growth. China's economy wobbles. The slowdown extends to the third quarter. This as Japan sees a consumption-led rebound. And get your Jordans on. Nike gets a boost after Bill Ackman takes a new stake. Hedge fund titans Michael Burry and David Tepper double down on their China bets. More to come on the 13F disclosures. I like that. It's not the first rodeo for Pershing Square in Nike. More on that in just a moment. How much of a sugar rush do you really want? Bostic says we can't afford to be late. Opens the door to September cut. Stocks are flying high for the fifth day in a row. You've managed to put on nearly 5% in value. What will retail sales tell you about the bifurcation of the U.S. consumer today? It is the roll down in CPI, and Ed Yardeni says, look, if you strip out the housing component, you've got sub 2% inflation. Of course, we need housing to drop. Other stock to keep an eye on is Cisco. They came out, there's Nike up 3%. Cisco flying higher, 6.5%. Again, job cuts and a guidance from them that the market had not exactly anticipated was coming. We'll talk more about the 13F filings in just a moment, but it is about legitimizing the pathway to a cut. The size of the cut is what we must debate. Yields at 383 this morning. Again, the market is pricing in 32 basis points of cut in September. There's no hurry. The hurry and the haste and that rabid calling for rate cuts has dissipated. The glide path on inflation is important. Jobless claims today, 235 is your number. But Raphael Bostic definitely saying we can't afford to be late is one that caught everybody's attention. Brent is bid this morning. Inventories are building by 1.4 million barrels. We made it below $80 yesterday. Again, you must consider the response mechanism and the peace narrative, or the roadway to de-escalation in the Middle East. I can tell you at $80.17, the algos are now still net short of Brent. So I mentioned Raphael Bostic a couple of times, and it was in the Financial Times where he spoke. And this is what he said. I'm open to something happening in terms of us moving before the fourth quarter. We can't really afford to be late. We have to act as soon as possible. Of course, this is about leaning into the dual mandate, the job side of the equation. Paul Dobson is with me. So, Paul, here is the debate. 25 basis points seems the inevitability, and that rabid call for 50 basis points seems to have dissipated for now. Of course, there's a couple of jobs reports to go.
Yeah, good morning, Manas. I think what you're saying is right. After the CPI figures, which were in line with expectations yesterday, no surprise to the downside. The market dialed back its expectations, or its hopes maybe, for a 50 basis point cut and went pretty much all in on 25. But starting in September, so finally we're there, just about to begin the cutting cycle that we've been waiting for most of the year. And markets seem pretty happy with that. They're not worried about the idea that the Fed's having to slam on the brakes. They're quite comfortable with the idea that we're going to see a gradual but steady reduction in yields. And by the way, you know, we're seeing that all around the world. We saw New Zealand this week also implementing some cuts and still feeling quite confident about the idea that it can do that gradually. All around the world, it seems to be that kind of message that the cutting cycle is beginning. But there's no need for us to rush.
No, there's no hurry. Perhaps a little bit more pressure on China to get its cutting boots on in size and scale. You look through the data, retail sales pretty much in line, but it's about the fixed asset investment and the overall trajectory of that economy. It's nowhere near where they wanted it to be by this point in the year in terms of the policies that they had enacted. And yet then I look at Japan. It's very much a divergent pathway for Asia, isn't it?
It is that, absolutely. I think for China, yes, if you look maybe beyond just the scope of today's data and the longer term, look at the bond market, especially, what it's telling us is that people are worried that China is facing, a deflationary or disinflationary spiral. It's facing lower for longer interest rates. People paying down debt rather than taking on new risk or new investment. Nobody is confident in the property market still. And so it sort of continues to trudge along. Now, The officials are aiming for 5% growth this year. It's possible that they'll get that without too much more stimulus anyway, but it's more the idea that, there's this kind of like sense that the economy is under something of a cloud. I don't know how much China matters in that respect for the rest of global markets right at this moment in time. It seems that, we've been here for quite a long while and the rest of the world has gotten on with things quite merrily. Look over at Japan, though. While everywhere else in the world we're worried about the cutting going too quickly, over in Japan we're worried about the possibility they might hike too fast. Felt like after the volatility that we had in markets last week, where we had the big blow up with the carry trade, the BOJ was chastened. It said, OK, steady our horses. We're not going to go too aggressively here. Market now looking for hikes towards the end of the year or even the start of next year. And that seems to have assuaged some of those nerves, calmed people down again. And therefore, markets are regaining a little bit more confidence. But at the same time, Japan's economy is showing some life. It is showing some strength in the consumer as well, the most important part to watch out for. And so that can give investors a little bit more confidence that that story can stay on track. OK, Paul, thank you very much. Setting the agenda there. That's Paul Dobson on the markets. Stocks are rising, as you can see. Traders are waiting for more economic data today. Peter Oppenheimer is the chief global equity strategist over at Goldman Sachs. Peter, good to see you again. So the data is coming along nicely. You then get a voting member from the Fed, Raphael Bostic, going, we cannot be late. The market's pricing 30 basis points for September. We seem to have shifted off full panic mode. So we're now in the insurance cutting mode. Do you think 25 basis points is a lock for September? Let's start there. Good morning.
Good morning, man. It's great to see you. Well, yes, that's our view. 25 basis points and then continuing at that pace per quarter. After that, we didn't think a 50 basis point cut would be necessary, largely because we felt the economy was still in a reasonably robust position in the US and actually would accelerate a little bit in the second half of this year. And the labour data, which was very weak, of course, and was one of the triggers for the correction a few weeks ago, we thought would improve a little bit at the next report. So I think a quarter is an appropriate expectation. And of course, the deep anxieties about the speed of a slowdown in the US and other economies is moderating, and that's helping to boost risk assets.
It is indeed. And when we last sat down, Peter, I was in London, the sun was shining, and neither of us really knew what was to come. Let's just reflect on what we discussed.
As we go into the second quarter with heightened expectations and a softening in the growth momentum data and these high valuations, some kind of setback, I think, probably would be quite healthy. And it's important to emphasize, I think, the risk of a bear market is quite low. Generally, if economies are growing, profits are growing and rates are coming down, it's unlikely you're going to see a major resetting downwards in equities. But a correction after the rise that we've seen, I think, is much more likely. And I think investors need to be looking at diversifying the risks a little bit as we move into the summer.
Peter, how long ago was that? I mean, that was barely 3 weeks ago. We had those highly erratic moves just over 10 days ago. The S&P 500 down by 3% on the Monday. The Nasdaq at one stage down 5%. My question to you would be the scale of the move. Were these irrational moves or cathartic, if I can use that word?
I don't think they were rational. I mean, what we were worried about, as you showed in that clip at the time, going into early July, was that stocks had risen really precipitously for quite a long period of time. I mean, the first half of this year, take the US, was one of the strongest first halves that we've seen going back over 100 years. And that doesn't really tell the full story because, remember, equities started to recover sharply from their low in October of last year. And from that point, they'd run up by roughly a third before this correction, and in the Nasdaq by about 60%. So there was a massive rise. The rise before the correction was very much driven by increasing valuations. And I think the expectations going into the second quarter were probably too high. So I do think that it was rational that, given the concerns about the weakening labour market, given the unwinding of the carry trade in Japan, that there should have been a setback. And in a sense, cathartic, I think, is the right word. It does rebase things a little bit. It brought some risk back into markets, and particularly the areas which had been most aggressively re-rating. But in the end, I think if we do have a continued progression of economic growth with the prospects of rate cuts, at least history would suggest that's a pretty good foundation for risk assets to make steady gains.
I think it's interesting that, Paul, when we reflected on the China data this morning, and we don't need to sort of unpick all of that, but there are pieces of warning flags in there. But we have got on fine in the US, things that have been fine globally, not without China, but much less emotionally dependent on what China does. We seem to have tacitly accepted that there's going to be 4.5% to 5.2%, that the growth is going to vary in China. Now, that's got much bigger bearing in Europe, and I know that you talk about buying the dip in Europe is perhaps not going to be as beneficial. So when you see those wobbles in China continuing, how much of a red flag is that, Peter?
Well, look, China is a vast economy. It's the second biggest economy, and it's inevitable it will have some effect on the global economy, and particularly areas and companies that are very dependent on demand from China. And we've seen that playing out. Many companies have warned on weaker demand coming through from China specifically, and that's hit parts of Europe where the overall exposures are much higher than they are, for example, in the corporate sector in the US. Having said that, of course, Europe also has a lot of very large companies with significant revenue exposure to the US, and they've done very well. So if we look at slices of the European market, and we have various baskets to do that, what we've found is very rational. Those that have particularly high revenue exposure to the US have significantly outperformed those that have got very high exposure to China. I think that really just does reflect the fundamental realities of what's happening to underlying demand.
It's interesting.
So Europe overall, to say, the economy is much weaker, of course, than the US. It's got some bigger structural impediments. Of course, it will benefit from falling rates as well. But we should remember that the stock market is not particularly representative of the European economy. And it's these slices of exposures which I think become much more interesting.
Now, look, I know you can't talk specifically about any individual stocks, but when you look at the narrative, let's say, from the 13F filings, there's some lovely rich stories for journalists to do. You know, Pershing Square puts its running shoes on with Bill Ackman getting into Nike again. The Cisco numbers were a little bit better, so it's bolstering the attitude of the market this morning. But I look at Michael Burry and I look at Tepper. Tepper is actually like a 26% of his exposure in his hedge fund to China. Michael Burry is raising his position in Alibaba. So it's an interesting pivot, let's say, in exposures at a time when we're very unsure where China is going.
Yeah, I think the bottom line here really is that it's not so much aggregate markets and the reflection of the economies that is important here, but specific stock opportunities. And I think that there are some great companies in China which have become probably too cheap, which are growing strongly and provide, quite exciting opportunities. And certainly my colleagues who cover that market very much would support that view. And it's a little bit, as I've been saying in Europe, it's not that we would advocate for a significant overweight of the broader index, say, relative to the US, but there are companies within it which are generating strong, steady, compound growth with relatively attractive valuations. And I think as equities get into a phase where they're less driven by rising valuations overall, we're likely to see an environment where stock-specific, idiosyncratic risk and alpha becomes more important in generating returns. And that means that having a more eclectic mix, a bigger spread across regions and even sectors, I think becomes much more interesting.
And certainly that diversification theme is becoming much more prescient in every conversation that we're having. Peter, thank you very much. Peter Oppenheimer there of Goldman Sachs joining me on the big stories this morning. There are other stories trending on your Bloomberg terminal. These are some of them. Cisco, as I've been saying, a bullish revenue forecast for the current quarter, thanks to a rebound in orders. However, the world's biggest maker of computer networking equipment announced plans to cut as much as 7% of the headcount as part of a strategy shift. 26 financial firms agreed to pay nearly $400 million in total fines. That's after the SEC said they failed to keep employees' electronic communications. The SEC says they remain committed to ensuring compliance in what has been referred to as WhatsApp investigations. Iron ore hit the lowest level since 2022 on concerns that the global supply is running ahead of demand. Chinese steelmakers are cutting output as they deal with a crisis, just as the major miners are boosting their exports. The metal is one of the year's biggest losers amongst the commodity stack. Coming up, Bill Ackman takes a new stake in Nike. More on the latest 13F filings right here on Bloomberg. Bloomberg Brief in New York with me, Manus Craney. Hedge funds continue to buy into big tech stocks, including Apple, and a few have trimmed their position on Nvidia. Betting on China is one of the biggest themes that has emerged from the 13F disclosures revealed on Wednesday. Let's take a deeper dive. We have our Bloomberg Deals reporter, Manuel Bagiori, in Hong Kong. Manuel, good to see you today. So Nike, put your running shoes on. Bill Ackman, he's got form here. He's been in this stock before, but Pershing Square disclosing $250 million stake here.
Definitely, Manus, thank you for having me on the show. Let's put our running shoes on. Let's go for a run together. Fascinating story as we saw the headlines waking up here in Hong Kong today. And anything that Bill Ackman touches becomes exciting news in a way. And with Nike such a powerful brand, as well as we've known, retailer has been struggling on its own to keep up with growth momentum. The shares have slumped almost 30% this year. So that's created an opportunity to for investors like Pershing Square to come and build a significant stake into the company. It remains to be seen what he's been gonna be pushing for, whether there will be any significant changes in his strategy or at the board level, but definitely interesting and worth watching closely. Also remind ourselves that Bill Ackman was involved a few years back when he made an incredibly good profit in a short period of time. So everybody's quite curious to see how this is going to play out this time around.
Yeah, well, what is it? In 2022, he said he was taking a quieter approach to management. So it'd be interesting to see, because, I mean, they had a thumpingly bad day on their earnings release a little bit earlier in the year, one of the biggest drops that we'd ever seen. Now, look, I caught up with Peter Oppenheimer just a short time ago, and he said, look, it's going to be idiosyncratic in China. And this is where Michael Burry and Tapper have maintained, in actual fact, they've increased some of their bets on the Chinese names. What did we learn?
Yes, very interesting point that Peter was making in your show just now. I agree, Manus. I mean, just looking at some of these 13F filings, right? I mean, we saw some of the positions, some of them paring back, others increasing in different, big Chinese tech companies, Alibaba, which is scheduled to report earnings today, as well as JD being amongst the most prominent one. We saw Tencent as well yesterday. The reality is the tech sector in China has been under so much pressure for so many years now after the regulators cracked down on some of these companies, right? So that's created an opportunity for some investors that have high conviction in the country and into the sector to build up their stakes. So we're seeing some investors kind of like doubling down in some names like Alibaba, as you well mentioned, Manus, and then others are kind of reducing or paring down positions as they see it properly at this point in time. But definitely China has represented an opportunity lately.
Okay, Manuel, thank you so much for being with me, running through the 13F filings. Coming up, we'll take a look at the other stories from around the world, including the former Google CEO's views on companies' work-life balance. Context matters. Bloomberg Brief. I'm Manus Cranny in New York. Your front pages look a little bit like this from around the world. First up, here we've got the New York Times. Columbia University president resigns after months of turmoil on the campus. The president resigned on Wednesday after a turbulent few months marked by campus protests over the Israel-Hamas war. She is the third Ivy League leader to leave their post in 8 months over this issue. Washington Post leads with the Gaza ceasefire talks. They're set to resume in Qatar without Hamas in attendance. Negotiations resume today in Doha. Hamas will re-engage after Thursday if Israel provide them with, quote, clear commitments on the group's latest proposal. And the Journal leads with the ex-CEO of Google criticizing the firm, and then he retracts it. Eric Schmidt claims that he misspoke when he said Google was losing the AI race because workers could come into the office 1 day a week. He emailed the retraction to the Journal after speaking at Stanford University. That is what you call the death of flexi working. Coming up, futures edging up ahead of more economic data. We'll take a look through the retail sales estimates with Stephanie Guild. From our global headquarters in New York, I'm Manus Cranny. It is Bloomberg Brief. Let's set your agenda. Rhetoric and softer inflation legitimize the pathway to rate cuts. Atlanta Fed President Raphael Bostic opens the door to September, warning we can't afford to be late. Diverging Asia growth. China's economy wobbles as the slowdown extends to the third quarter, while Japan sees a consumption-led rebound. And get your Jordans on. Nike gets a boost after Bill Ackman takes a new stake. Hedge fund titans Michael Barry and David Tepper double down on their China bets. More on the F-13F disclosures to come. Good morning. Welcome to the show. Day 5, going into day 6 of the rally. We're eking out an eighth of 1%, but over the past 5 days, equities have put on almost 5%. And then adding to the elixir of life, Raphael Bostic, who votes on the Fed, he said he's open to rate cuts in September. We can't afford to be late. Rates are fairly, flat. We'll see what retail sales do today. But the legitimacy of the CPI laid the path clear to rate cuts in September. The question now becomes the nuance between 25, as Peter Oppenheimer at Goldman Sachs was just with me. It will be a series of 25 at each meeting. That's what's to come. Nike, get your running shoes on. Bill Ackman is back again. Come back, Bill. Pershing Square has a chunk of Nike on its book, $250 million. We'll talk about that in just a moment. Roll it over, have a look at Cisco, job cuts and a forward guidance, which improved. By the way, Dell, keep an eye on Dell there as well. JP Morgan, add this to the list with the price target of $160 versus $155. That is a chunky upgrade from JP Morgan. Now, in terms of your oil market, be grateful for what you get. That went sub $80 yesterday, and that drop in oil is something that snapped a little bit of attention. The algos are actually net short of oil, despite all of the geopolitical tensions between Iran, Israel, and the ceasefire talks, which we have starting again today in Doha. I want to focus in on Cisco for just a moment. It was a whopper by any means. The guidance. The guidance was brought up to 13.65 to 13.85. Yes, they are reducing their headcount. That's going to cost the company about $1 billion. You're looking at 6,300 jobs to go. They have got 90-odd thousand employees, 90,400, so a 7% headcount reduction. I think the narrative from the CEO is important. The period of inventory digestion by our customers is now largely behind us. And this is about shifting and making the organization fit for AI purpose, shifting to cybersecurity, cloud systems, artificial intelligence-related movements. So that is about changing the chess pieces internally to be fit for purpose in an AI world. My guest this morning is Robinhood's Stephanie Guild, weighing in on the market sell-off a little bit earlier this month. You'll remember it. Elevated expectations and valuations made the markets ripe for correction. We had called for one to happen down to 5,100 by September. The Fed did not give the markets what they wanted in terms of committing to the cut. That, coupled with weakening labour force data, caused a temper tantrum. Stephanie is with me now. There's nothing better than a tantrum to bring out the dip buyers and people like me to look back in the rearview mirror and go, oh, I've missed that opportunity again. Is the tantrum done? Is it past? I mean, the roadway cuts are on the way, Bostic's bidding up cuts. It's all good.
We had elevated expectations and valuations going into it, and that's why we called for a correction before September, or by September, I should say.
Yeah.
And S&P PE was around 21 times the time that this happened. It's back down to 20.4 times around there. The thing is, we thought it was going to be a correction because they happen. Seasonably speaking, they tend to happen in the summer, and they're very normal. They tend to happen once every 1 to 2 years.
Now, you got a correction in the NASDAQ, I will give you that, but you never got the correction in the S&P 500 because ultimately the surveys come out and say, look, still, big tech is a bulwark, we want to buy it, it's in the 13F.
Technically speaking, you didn't. It got down to 8.5% down. So
I know, we're quibbling over 1.5%.
It was close, but we expected some sort of pullback before September came. But we weren't that worried about it because we didn't see that much of a worry around the economy. This was more about the Fed. The market threw a temper tantrum, and as a parent, I can tell you that I know exactly what happens when you don't give your kids what they want. And we've seen this before. But what we saw is that this was about labor market and getting worried about a slowdown, and we just don't see this being a big issue because we see that labor participation has increased.
And this is fundamental because we can debate unemployment rising by 0.5%, triggering the Sam rule. Claudia Sam herself has said, don't lean too hard on that. But you're not convinced about the softness in this labor market, full stop.
Not yet, no. I'm not. I do think if we get to unemployment rates of around 4.5%, I do start to get worried. Then that
triggers something different for you.
Yeah.
I'm desperate to get somebody to talk about a specific stock in 13F, and you are the first person through the door, so here's your winning moment.
Let's do it.
I really like the Nike story. I like the fact that Pershing Square Bill Ackman is in there. There's a shift in activism, isn't there? You know, you look at the transfer out of CEO, out of Chipotle into everybody. I got it wrong. We've just corrected. Chipotle. Everybody's on my case. Chipotle. Out of Chipotle into Starbucks. That's activism. Here's Bill. He's back in again. He was there in 2018. What do you make of that kind of move? Fast and furious?
I mean, I think personally we're focused on income-oriented stocks, low volatility stocks, things like that. So, consumer discretionary has not necessarily been a strong focus for me, but there are valuation opportunities. This is a stock picker's market. We have lower intra-stock correlations than we've had in a long, long time. And so I see the value of it. Like you saw, Nike rallied when, the CEO move went from Chipotle to Starbucks.
Yeah.
I think it's part of that. I think it's part of fishing for value.
I would say that we're going to move into a more active disruptive shareholder value creation. This is what we're going to see a little bit more of.
I mean, margins have been under pressure. Like, even though earnings came in above expectations for the second quarter, you saw margins came in way below that. It was actually by 2% at the S&P level and much more sector.
So that gives latitude to activism, doesn't it?
It absolutely, and it provides opportunity, looks for cost cutting, or looks for better revenue.
And in part, Cisco, I love Cisco giving out the guidance, upping the guidance, but we're letting nearly X number of thousand people go, 7% of the workforce go.
Beginning of this tech super cycle infiltrating other parts of the economy.
Do you think that is not a canary in the coal mine, but I mean that's a reality? Tech had a big cutting cycle last year, and we were told the worst was over. So again, it's interesting to see that come through overnight, isn't it?
Yeah, I think it's part of the beginning of this tech super cycle, and not all parts of the labor market are going to benefit from it in the short term. I think in the longer term, you've seen many industries over centuries change, and eventually everyone finds their new roles.
Exactly. We all stop shopping. What is it? We all go to Hoka rather than Nike. But that's part of the problem. I said to somebody yesterday, "What is it with Hoka?"
Well, Nike does have a lot of competition. There's a lot of sneaker brands out there.
There is a lot of sneaker brands out there. You like healthcare, and I'm just curious to know whether that is from the evolution of what's coming down the pike with GLP-1s, or is it about defensive nature? You like both AbbVie and Eli Lilly, both together.
Yeah. It's actually both. I would say right now, because of the fact that we are in a stock picker's market, that interest rates are likely to start coming down, but not materially because of a lot of other reasons, especially on the long end of the curve, or deficit, to name one. I think that there is still a latitude to focus on growth, but you have to do it in a place that is you're mindful of whether they can actually make those valuations either look not so high longer term because the earnings are better than expected, or they are coming out of something. And AbbVie is one of those. I think they've had negative earnings for a couple of quarters. And they actually, on the side, benefit from the GLP-1.
Yeah.
Right? And then Eli Lilly, even though like we've seen a lot of companies have crazy demand that they can't keep up with, Eli Lilly so far has done a really good job at keeping up with their demand.
We've managed to speak for like 6 minutes without talking about the Fed, so I suppose you know we are kind of duty bound. We can't be late. That's I thought it was interesting. Bostic sort of is one of the first, I think, to put his head right above the parapet and now talk about the risk of being late. Goldman's were with me just a little bit earlier on. They're still very much steady as she goes, 3 clips of 25 at a time. How much does 0.75 percentage point cut in rates really mean? I know real rates are tight. I understand the basic thesis, but I want to know from a risk perspective and from an equity investing perspective, how does that shift the dial?
I think it's a signaling that the Fed is aware. I think we actually already landed from an economic perspective, and now we're just waiting on the tarmac. And if the Fed gives us a gate, then I do think we eventually, I think it's the signaling that helps. Yes, we care about growth. We don't just care about inflation. And that's where they need to be, I think, just given all the data we've seen. And by the way, CPI being below 3%, I know this is on a headline basis, not a core basis. That is the same when the Bank of Canada started cutting, when the ECB started cutting. It was right when they had a 2 in front. They weren't necessarily much, back to full 2.
And just on that, Ed Yardeni, in his piece yesterday, sent through, said, OK, and I know everybody's going to scream at the TV, which is, excluding shelter. Oh, man, shelter was up yesterday.
It is hard to say excluding shelter. But I actually think inflation in shelter will come down once rates start to come down.
Well, this is the kind of narrative that he has propagated, which is, I was reading, I was going, why are you doing that? Why are you ripping out shelter? Take out shelter from the headline and the core, and it comes in at 1.8 and 1.7%. But that is trying to get that's trying to write to your narrative. Isn't it?
I do think a little bit of data mining there, because 90% of the increase did come from shelter.
I know.
And shelter is the biggest thing we all spend money on, so I don't think we can ignore it. But I actually think it's going to take rates coming down a bit, because then you have people refinancing, you have people able to sell and buy a new home. Like, I just think
rents will come down once they cut?
Because more people will be able to buy a home, potentially.
I'm ever hopeful for the silver lining. Stephanie, great conversation with you this morning. And I like the analogy. We're on the tarmac, so hopefully there's no potholes on the way to the gate. Stephanie Gill there of Robinhood Markets. Coming up in the show, the Harris campaign hits the trail with President Biden for the very first time. Context matters on Bloomberg. It is Bloomberg Brief and Menace Crenny in New York. Good morning to you. Shares in Nike extending their gains after Bill Ackman's Pershing Square disclosed a new stake in the latest 13F filings. Let's take a closer look. Manuel Bagliori is with me. So this is take 2 for Pershing Square in Nike, and the stock's had a nice bump. How active do you think you'll be this time around?
And that's the million-dollar, question, Manis. Thank you for having me on the show. I mean, Bill Ackman again striking, buying a stake in Nike. The shares have been down almost 30%, up 5% on the news after the investment was revealed. It remains to be seen how involved or how much is he going to be pushing for changes this time around. Remember that a few years ago he also had an investment for a short period of time, and that turned out to be quite profitable for Bill Ackman. The sportswear company under a lot of pressure, especially after that bad day in June, one of the worst days in history for the company when the stock plunged. So it remains to be seen what the company is going to do to turn around the situation, and then based on that, we'll see Bill Ackman's involvement into the day-to-day strategy as well.
Manuel, thank you very much. And Nike has a nice bounce this morning pre-market. Bloomberg's Manuel Bagliori. From Wall Street to Pennsylvania Avenue, President Biden is slated to join VP Harris on her campaign trail for the first time in Maryland. Bill Ferries joins me with the agenda. It's going to be a busy couple of days for them. What's the signaling here? This is going to be a very powerful moment. The first time Harris is seen in public with Biden. How important is this for transference?
Right. Well, we did see them together from a distance when those American hostages or prisoners came back from Russia. But this is the first time we'll see them on a stage together at a rally with basically Joe Biden in full campaign mode for Vice President Kamala Harris. Still the kind of thing that even a month ago would have sounded very strange to all of us. It's expected to be a rally focusing on the economy. We know Vice President Harris is going to give her first big policy speech on the economy on Friday, but this will be symbolically and politically, I think, an important moment to see the the president and the vice president on stage together after everything that's happened over the last 3 to 4 weeks.
Listen, she wants to go after helping the working people of America, the price gouging. We understand over the next couple of days. We're going to get a little bit more detail on what she's going to try and do if she gets into power in the first 100 days. And it's very much countering the Trump narrative. He's on tariffs, he's on taxes, etc. This is where she tries to draw some economic distance.
This is where she's really going to try to narrow this gap that former President Trump has had really since he entered the campaign. He had a big lead over President Biden when it came to Americans' trust of who would manage the economy better. He has a narrowing lead over Vice President Harris on that, and it's a real strength. I mean, voters, the economy is always going to be one of the top couple issues they talk about when they head into the polling booth. And this is Harris's chance to stake a claim to be, really focused on working class people. The White House just announced early this morning a plan to reduce the price that particularly older Americans spend on 10 key medicines, some of the 10 most important medicines in the Medicare program. She's going to talk about trying to go after price gouging in grocery stores and the food industry. So really, even though, as we've talked about, inflation has been slowing in the United States, people feel like prices are high, and she's going after that and trying to lay out an agenda that for her maybe goes beyond what President Biden had previously announced.
Look, some of the bulwarks of the Biden administration, the Inflation Reduction Act, the CHIPS Act, around green energy, etc. Does she draw herself close? Does she align herself to those policies? Or does she try to, as it were, differentiate herself and move away from Biden over time on some of these policies to differentiate herself?
Yeah, I think, there's a lot of people who are going to be looking for any nuance or separation between her and Biden's policies. I think, if President Biden had stayed in the race, I would have expected him to be coming forward with more proposals as we got closer to November. We don't know what those would have been, but Vice President Harris is basically doing a similar thing where she's, as voters start to pay attention to what's going to happen in November and make their final decisions, particularly those independent voters in the battleground states. She's going to be reaching out to them with these policies, just as you've seen former President Trump trying to do so with his talk about tariffs and immigration at the border.
OK, Bill, let's see what today's political piece of theatre and over the next 24 hours brings us on policy and theatre. Bill Ferries there tracking the campaign trail of Vice President Harris and the President of the United States. Pre-market, there you go. You've got Walmart up barely 0.75%. Earnings are on the slate today before the bell, along with the retail sales data. So it's going to be a fairly defining day. Bloomberg's Dasha Afanasieva joins me now. Look, we know time and time again, consumers are becoming a little bit more judicious. They're becoming a little bit more price sensitive. When it comes to Walmart, what are we going to be focused on?
Morning. Absolutely. It'll be the state of the consumer. You've already had companies like PepsiCo and General Mills and Nestle talk about how tough it is in the U.S. environment, how it's a discounting promotional environment, and how particularly consumers at the lower end of the scale, at the lower income end of the scale, are really struggling to budget because of this prolonged period of high interest rates, high mortgage rates and high inflation. But of course, for Walmart, in some ways, this is also an opportunity because it is own label products that consumers are sometimes are sometimes trading down to. And that's why it's launched its biggest own label brand, Better Goods, in 20 years to try and capitalize on that momentum. In addition to that, it's also growing its e-commerce division quickly and has actually been gaining market share.
And that's, if you look at what Morgan Stanley are writing about, they're saying it is what they're doing with their membership and their marketplace that is going to be key. Let me just read to you what Ed Yardeni says about the U.S. consumer this morning. Spending hasn't declined, but it has shifted. And this is the critically important part, leaving retailers of out-of-favor items out of luck. So this is about loyalty in the programs that they create and the data that they mine.
This has been the trend in Europe as well. So Walmart has been, as you mentioned, working really hard to keep that consumer loyalty and grow its market share. And I think the other way I've heard it described is consumers shifting back from goods, back to services, and this sort of post-pandemic shift. And we had Home Depot this week talking about how consumers are actually deferring big ticket spending until interest rates are lower. But I think all of that for Walmart means that they just have to be a lot smarter in thinking about the longer term trends in their business. And so far that seems to have been paying off. So this quarter we're not necessarily expecting an upgrade because they gave us one last quarter and they said that sales are going to grow at the upper end of their estimate or even just above. So it seems like at the moment the street at least thinks that they're playing the game right.
Yep, it depends how much you can extrapolate from Starbucks and Home Depot across. It's a very, very crowded field in that area. Dasha, thank you very much. Let's see what Walmart delivers before the bell. Dasha Afanasieva. Coming up in the show, as I say, more earnings, economic data for you. The president and vice president are coming out together. Context matters on Bloomberg. Good morning from New York. Here's what's ahead on the track today. Walmart and Alibaba will report before the bell, so they're going to define really where we are with the retailer. That takes us through to the actual retail sales, 8:30 a.m. Eastern Time, and jobless claims. Just remember, this time last week, jobless claims, it turned out to be really quite pivotal in the overall direction of travel. Then it is about politics. Vice President Harris, President Biden will deliver remarks in Maryland at 1:30 p.m. Over the next 24 hours, you're going to get a little bit more on economic policy from Vice President Harris. Some stocks on the move. Cisco extending their gains, upbeat sales forecast, despite the fact that they are cutting jobs. Ultra, SiriusXM, the shares jump. Warren Buffett's Berkshire Hathaway filed 13F filings report, taking a new stake there. Look at that, up 15.46%. Leave you with a snapshot of the bond market. You're going to get retail sales. Raphael Bostic, voting member of the Fed, makes it very, very clear that we cannot be late in the cutting cycle, and he opens the door, lays the groundwork for a September cut. And Goolsbee also warning yesterday, being concerned about the employment status. Yields tick ever so slightly higher.